Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, June 8th, 2019. So pretty straightforward program today. We will cover stocks which are moving towards fresh highs. I'll give several trade examples from foreign markets that we trade, namely Greece, Russia, Switzerland and Philippines. And we will look at the yield curve again, because Federal Reserve, I think, is going to have to cut the interest rate pretty soon as the yield curve inverts, and I'll show you what I mean. We'll look at gold and some of the forex components as gold rallies and dollar is under pressure, and we'll finally finish off with Litecoin, Bitcoin and other cryptos. Alright, so let's look at S&P 500. This is the futures of S&P 500, and on this chart, let me zoom in, you can see four horizontal lines, the green, blue, red and yellow lines. These are proprietary indicators, trading indicators that I wrote that you can have on your chart as well. Simply go to MasterChartsTrading.com and sign up. You can also sign up at TradingView, and you can see that this is TradingView interface, and you can chat with me if you want. I'm at MasterCharts. So S&P 500 again it came down towards the blue line. Notice it did not touch the blue line, so I didn't send an alert for this particular one. My personal preference is to see a correction a little bit deeper, so around to the blue line, and then I'm going to start buying. This obviously did not occur for S&P 500, but it did occur for QQQ, and here is an actual alert to my subscribers on June 4th, right there, and this is already enough to make money. In other words, if you consistently simply get about, this is 2 ATR, so ATR, average true range, is this indicator right there, is basically how much on average a stock moves. In this case, QQQ moves, and you can see right there where I'm hovering, on average about $3. And what we did is we did a trade. We bought right at the blue line at 173, around 173. It's already at 181. So you got more than two average true ranges. You know, one average true range is $3, two average true ranges is $6, and you got a little bit more than $6 actually, $7 or so. So you definitely have your enough price movement to make this trade workable. So right now there is a debate going on whether or not this is a head and shoulders. You can see it on QQQ, you can see it on S&P 500. There's the left shoulder, possibly this is a left shoulder. This is the head right there from the May, and this is the right shoulder. But as I keep telling to my subscribers, those patterns, and I have sworn off pretty much all of the chart patterns, they most of the times don't work, and it will take you many years to be able to identify those patterns. And then once you're able to identify those patterns, they still don't work all the time. So even if you correctly identify the pattern, it still may not work. So I just basically ignore them, and I use my indicators basically. I'm only interested in levels. Where do I want to be buying and selling at what level? So in this case, the level was clearly marked in the chart with my indicators, and you can see it. It was there already, 173 right there where I'm hovering. It was already that on 29th of May. As we continue advance forward, right there on the 4th of June, it's just straightforward. We just buy once there is a touch of the blue line and the close above it. So this is all there is to it. And many traders make things unnecessarily complicated. I don't like complications. I like to be, straight, simple trades, and this is one of those trades. So basically just don't complicate things. Same goes for Dow Jones, DIA, and this is an actual alert again on 29th of May to my subscribers. Right there, I sent an alert at 2:51. I made a target of 2 average 2 ranges, and again where I'm hovering right now, this purple line, and it's $3. So on average this particular ETF moves about $3, and after the alert was sent, this ETF actually moved $10 in our favor. So overall, obviously a profitable trade, and you could already make money on that. As we go a little bit deeper, and we can look at individual stock sectors, and here's one, XLU Utilities. You can see a fresh record all-time high. Yes, utilities are leading the charge higher now, probably because the interest rates are still coming down. Utilities need to borrow a lot of money constantly to keep their projects operational, and lower interest rates obviously would be good for borrowers such as utilities, so they have a better profitability in this environment. And notice that utilities are currently at record highs. Same goes for XLP, consumer staples. Now again, two of the most defensive sectors are staples and utilities, and to a lesser extent you can look at IYR, real estate, also a fresh record all-time high. And you can see actually on this one, this is an actual alert again, and I don't trade that often, but open this kind of position. So you notice that alert was sent right there on the 17th of January, and you can see the appreciation was 13% already. Let me move this thing over. 13% move in our favor for an ETF. So remember that there's many different stocks in this ETF. So overall, individual stocks probably moved even more, some of the individual stocks. But the point I'm trying to make here is all stocks contribute to the general stock market, and even though occasionally you have some sectors, such as for example energy, XLE is underperforming, other sectors such as XLP, consumer staples, utilities are at fresh record highs. I would trust more to the record highs than to a mild underperformance, because overall I think the stock market is obviously bullish. Here's another one, XLK, technology sector, basically similar to QQQ in composition, slightly different. So XLK broke out a little bit even earlier, record highs recently. Record highs always only mean one thing: this is a bullish chart. It's that simple. If there is a record high, don't think of anything else. Think of only buying. So in this case, record high, a pullback. I was waiting for this pullback. Pullback occurred exactly where I wanted it to occur, or it occurred exactly. It pulled back to the levels of where I wanted it to pull back. It is basically exactly at the blue line. You can find out more about the indicators. But what we did is did the same thing. We simply bought once the indicators were touched, and then there was a close above it right there on June 4th. And then you already have more than enough to make money. Most likely we will make a new record high. I don't know if this is going to be exactly right this instant, but it will very likely happen, because record highs usually mean there will be more record highs. Another record high, XLY, that was set, let me see, it was set in April of this year, but notice how it just corrected exactly to the blue line right there. And the same thing happened right there on the 8th of March. This is why I like my own indicators. It's just so simple to use. It simply corrects. You want to see a correction to the proper level and then initiate position. That's all you have to do. Straightforward. Some of the stocks that we also trade are some of the foreign ETFs, and there's some interesting action here in foreign ETFs. Here's one, Greek, GREK, and interestingly enough, there's the big gap from 24th of May until 28th of May. very large move, and some people would say, wow, you can't be buying after such a big 7% move. But I say, basically this is it. We broke out above the blue line right there on the 28th of May. This was my trigger. This is the only thing I'm looking for, is a close above the blue. I sent an alert immediately, and then we got a nice trade already in our favor, and it is most likely going to continue higher. If you are a kind of more worried about profits, then you can take profits and also advance your stop. Once you take profits and advance your stop, you can't lose on a transaction, and this brings a big a greater peace of mind for the trader. When people trade, they get very nervous, and you want to be extremely cool when you trade. Another one, Russia. Here's RSX. You can see pretty much similar price action. Now, initial breakout, you can see that it was in a bear market below the yellow line, and then there's the initial breakout right there on 20th of March. And then at that point we just start buying. So the couple of alerts right there we can see on the 21st of March, another one on the 5th of April. Here on the 9th, 10th and 13th of May, I didn't send an alert because I just missed it. And this happens sometimes. I have probably close to 200 various stocks and ETFs that I follow. So occasionally you miss a trade, but just to show the basic principle, and we just simply buy above the blue line. So if I was going to send an alert, I would have sent it on 10th of May right there. And it's already over 7% gain, and most likely going to continue higher. Again, this is a bullish chart. My position, EWL, and this is Switzerland, Swiss stocks of various sorts. Obviously, an ETF contains many stocks, and the alert was sent right there on the 15th of February. I kind of like this type of patterns where the indicators come down, price comes up. We just take it easy and close it and open the position once there is a close above the blue. Now it doesn't happen all the time, but look at this beautiful move. I'm not even sure why I sold half here. I think I was a little worried that my profits will get wiped out, so I sold half, advanced my stop to above entry. I can't lose at this point. It means I'm very comfortable in my position. And notice what happened afterwards. It continued to fresh high. So I'm currently basically advancing my stop and just doing nothing. In trading, there's a lot of doing nothing. You just kind of sit and stare at the charts occasionally, but most of the time you just open the position and sit in it and do nothing. It's kind of like hurry up and wait, I guess. Philippines, EPHE, and I wanted to highlight actually a few recent trades. The initial one, and notice again the same thing. Here's the breakout right there on 28th of January. A few days later, an alert was sent. Notice that target was reached finally a while, just now. But that's what I'm trying to say. This is the essence of why my trading rules succeed, is that I don't really care about time that much. Of course, if I'm trading options, I do care about time. But when I'm trading stocks or ETFs, I'm just buying them and doing nothing. I can sit for a very long time in a position. Notice here, let's say you opened back in January, that means you would have to wait for 84 trading days or 123 regular days, including the weekends, before the position finally resolved in your favor. But do you care? Some people do care because there is a cost of capital. Because if you sit in the position for significant amount of time, you have the opportunity cost. Maybe you can put your money to work somewhere else. That's fine as well. I don't look at it that way. I'm more relaxed, and I'm just simply looking at the price levels. If the price level is good, and for example, right, on the 15th of May, this is all I do. We just look for a drop below the blue line or just a touch of the blue line, and then simply a close above it. And there it is on 14th of May. On the 15th of May, I sent an alert. A few days later, it went in our favor, and there is a nice over 9% gain. So again, congratulations if you opened the position recently for Philippines. And you can trade any ETF, you can trade any stock, you can trade pretty much any tradable security so long as there is data being recorded. All right, let's look at bonds and the various yield curves. We can look at bonds. First, let's look at TLT. There's TLT. I went long. I bought 11th of January. Same reason. There's the breakout on 31st of December 2018. The breakout occurred right there. I actually sent a couple of alerts. There's one alert for me that I bought on 11th of January. Still sitting in the position. Sold 3/4 of the position, but I'm still sitting in the rest of it. So very profitable, very nice position. Still moving higher. So again, I will, in a few seconds, I will delve into the yield curve. But notice the reason why yield curve is doing what's it doing is because bonds are gaining. And here's, for example, 30-year Treasury note yield, and it's making fresh lows. Alright, so TLT, the long-dated treasuries, made a fresh high for the move recently. Intermediate dated treasuries, IEF, made a fresh high on Friday, and so did BSV, or short-term bond fund. So overall, this is, generally speaking, not a very good sign. And let me show you why I think that is not a good sign. So here is a few things, and I'm not making it up. So yesterday, or today actually, and today is June 8, 2019, I just did a quick search, Fed interest rate, and notice what came up. They need to cut the rate. Rate cut. I agree with this assessment, and here's why. So let's look at historical trends in the yield curve, and yield curve is right there, the one on the left. So this red line is showing the yield curve as it was. You can kind of read it there where I'm hovering, 31st of January 2019. This is more or less a normal yield curve, because you can see that the lower, or rather the shorter shorter term interest rate is 2.32%, and it is lower than the longer term interest rates. But you can already see that the intermediate term rates, right there where I'm hovering, are coming down towards the short term rates. Why do I give it a damn about this? Is because if we do a historical analysis, we can see that in the past, for example, here is year 2000 where I'm hovering, and on the right here is S&P 500. So around year 2000, the interest rates, you can see that the long-term interest rates were actually lower than the short-term interest rate. This is called a yield curve inversion. The same similar thing occurred around 2007, yield curve inversion. The yield was low, or rather higher for the short-term bonds than for the longer-term bonds. We're now kind of getting there, and I'm going to advance, and you can kind of see the way it's been behaving. You can see that there's the inversion. You can see the short-term interest rates are higher than the longer-term ones, and this is getting worse and worse. And notice significant inversion right now. lower interest rates for 2-year, 5-year, 7-year, 10-year, advancing almost to 20 years, about 15, 16 years. Interest rates, you can see they are inverted. In other words, short-term yield is higher than the longer term. So this is the reason why Fed needs to drop the interest rates, is so that at least the short-term yield is going to be lower than the long-term yield. Will it save the economy? We will find out soon. But at least, I think that they did a smart thing, that they at least raised the interest rates over the past few months, when did they begin raising the interest rates? It was basically zero, a few years ago, and notice that they began rising, and then now we have the partially inverted yield curve. So overall, not a good sign, but nothing could happen, or we could see interest rate drop because of the federal interference. If the Feds drop the interest rates, then the curve will normalize. But the way things are going, it feels like there is more room to run to the upside for the various bond funds. I mean, I'm sure there's going to be a correction of some sort. Perhaps it already has started. But the question is, how deep is the correction, and is it going to be a reversal? I don't see any evidence of a reversal for bonds yet. So we will need to basically wait for the Federal Reserve to do something, because this is not a good sign right there, inverted yield curve. Let's look at commodities, and here's one that I monitor quite frequently, and that's gold. A couple of alerts for my subscribers. Recent alert happened right there on the 6th of May with a nice 5.3% gain. If you trade futures, you know that this is a very large gain. I myself opened a position in GDX, gold miners, right there. Alert was sent to my subscribers as well, and I'm still holding it. I already advanced the stop to above entry. I may take some profits, but I'm not sure I will yet, because it seems like it wants to go higher. Dollar index, by contrast, is possibly, I'm going to be very cautious on the statements, because I've been saying the same thing, but notice how wide this trading range used to be, and I'm talking about this distance between the green line and the yellow line just back in April, and notice how narrow the trading range has become. It's only, let me see, 1 second. It's only about 3.7% versus 6%, almost cut in half. If we see a drop even further towards the 95 levels, towards the red line, then I think dollar index will turn around, and by extension the various components of the dollar index. So for example, here is euro versus US dollar, and the same thing. Notice the trading range is narrowing. So the trading range is now around 4%, and it used to be 7%, you can see right there. So the distance that the price needs to travel towards bullish levels, and bullish levels are at 1.15497. I can read it right there, because you can see it's right on the chart. Not that far, so it's possible that euro is finally turning around. And if that happens, then gold will certainly benefit. Finally, let's wrap up with cryptocurrencies. Here's Litecoin, and it's very close to fresh highs, and it's kind of leading the other cryptos higher. There's the breakout on the 2nd of April. This is an actual alert to my subscribers right there on the 26th of April with a 66% gain. I mean, those things move like crazy sometimes. My position, Bitcoin, right there is the breakout on the 7th of May, and I sent an alert, and I opened myself a position at 57.11, and a few days later I sold half at 77.50, and I'm still holding the remainder. So overall, a wonderful, beautiful transaction. So I'm still holding that could potentially continue higher. Finally, Ethereum also is looking pretty good, and I would be considering opening new positions if it drops to around 212. Same thing. You can see the breakout. Excuse me. Right there on the 13th of May. There's the breakout, and that's all we do. We just look at the breakout, and then we look for buying opportunity, and we sometimes just buy on breakout. So that's also a good way to do it. Okay, so if you're interested in the way I trade, you can do several things. Number one, of course, go to MasterChartsTrading.com. That's MasterChartsTrading.com. Click on the sign up button right there and subscribe to one of the services we have. So the alerts I'm referring to are these type of alerts, and you get those with the $24.95 per month or $20.83 per month if you sign up for yearly. All of our plans have a risk-free, no-charge trial, 30 days. All you have to do is just cancel it within 30 days, or you can just send me an email and I can cancel on your behalf. Of course, if you want to just trade on your own, you can get this trading indicators, and I'm talking about this green, blue, red, and yellow line. All you have to do is just sign up, and I'll explain how it works. It will take you about 5 minutes, not even. And then if you want to do both, you can get alerts and my indicators. Then you can get both of them for a very good price, I think, because if you were to buy them separately, you will pay in excess of $50, but you're paying only $45.95 per month, and even less if you sign up for a full year. That's it for this week's recap. If you have any questions, please send them in. Thanks for watching, and have another great trading week. Bye-bye.